Imagine a technology that promises to instantly shrink the world, open up new markets, and rapidly accelerate global commerce. In the early 1870s, that technology was the steam-powered railroad. Iron tracks were tearing through the American frontier. This was a physical expansion that pushed the absolute limits of human labor and engineering. To fund this massive infrastructure project, American developers looked overseas. European investors, flush with cash from war indemnities following the Franco-Prussian War, were eager for high returns. They bought up American railroad bonds by the millions. Between 1868 and 1873 alone, the United States laid over 33,000 miles of new track. That was more rail than the rest of the entire world built during that exact same period. For the first time, continents were strictly tethered together. Wealth sitting in a London or Berlin bank vault was directly financing the timber and steel being laid in the Dakota Territory, creating a single, highly pressurized global economic engine. At the center of this engine sat Jay Cooke and Company. Jay Cooke was the man who financed the Union Army during the Civil War. By September 1873, his bank was considered the absolute untouchable bedrock of American finance. But Cooke had bet heavily on the Northern Pacific Railway, a line stretching into the empty, frozen wilderness. When European investors stopped buying his bonds, Cooke ran out of cash. On the morning of September 18th, his firm declared bankruptcy and locked its doors. The psychological shock on Wall Street was immediate. Panicked depositors rushed to withdraw their money from other banks. The chaos grew so severe that the New York Stock Exchange completely halted trading and remained closed for 10 straight days. If Jay Cooke could fall, no one was safe. The collapse revealed that the entire economic expansion was incredibly fragile, leaving citizens to wonder how a thriving global market could short-circuit overnight. The first vulnerability was the tracks themselves. Driven by generous government land grants, companies were building lines miles ahead of any actual consumer demand. They were laying rails into empty prairies, betting that towns and farms would appear later to pay off their massive debts. At the exact same time, governments actively shrank the amount of money circulating through the economy. Through the Coinage Act of 1873, the United States joined Germany in moving toward a strict gold standard. The U.S. Treasury preemptively stopped minting standard silver dollars, completely cutting off silver as a legal tender. This decision drastically reduced the domestic money supply. The global economy was caught in a trap. Businesses and farmers had taken on massive loans to expand, just as the cash required to pay those loans back was pulled out of the system. The actual spark for the panic didn't come from New York. In May of 1873, a localized real estate and railway bubble burst in Austria. The bottom fell out of the Vienna Stock Exchange. Desperate for cash to cover their losses, European investors issued margin calls. They instantly stopped buying American railroad bonds, cutting off the flow of capital across the Atlantic. Without fresh European credit, American railroads defaulted on their bonds and entered a legal process called receivership. Because they owed massive debts to existing bondholders, no new lenders would step in. Without cash to buy coal or pay workers, the railroads simply froze operations, stranding the remote towns that depended on them. A paper panic in Vienna had traveled at the speed of the telegraph to America. A financial loss on a ledger overseas instantly caused physical trains to stop running in the Dakota Territory. This gridlock triggered a severe bout of deflation, which mathematically crushed rural Americans. If a farmer borrowed $1,000 when wheat was $2 a bushel, he needed to grow 500 bushels to pay it back. But when the money supply shrank and the price of wheat dropped to $1, that same farmer suddenly had to grow 1,000 bushels just to cover the exact same loan. The pain cascaded through society. 18,000 businesses failed. Massive railroad strikes erupted into violence, and tragic failures like the collapse of the Freedmen's Savings Bank wiped out the life savings of emancipated African Americans who had entrusted their money to a system that gambled it on risky rail bonds. Despite massive public pressure to print paper greenbacks and relieve the debt burden, President Ulysses S. Grant refused.
He vetoed the inflation bill, committing the country to strict sound money policies backed by precious metals. There would be no government bailout. The initial panic of 1873 hardened into what became known as the Long Depression. forcing working-class citizens to endure years of brutal economic contraction. Look at this chart tracking the 1870s economy. While the red line showing prices, wages, and profit margins plunged, the green line tracking the actual volume of physical goods produced and transported aggressively spiked upward. This happened because the crash ruthlessly cleared out weak, speculative businesses. The companies that survived had to optimize every single process just to stay alive. The result was a massive leap forward in industrial efficiency, which ultimately drove down the cost of food, fuel, and manufactured goods for urban workers who managed to keep their jobs. And the elite capitalists who maintained their cash reserves capitalized on the carnage. Titans like Cornelius Vanderbilt swooped in to purchase bankrupt railroads and steel mills for pennies on the dollar, consolidating fragmented lines into massive monopolies. The devastation of the 1870s cleared the rot of the speculative bubble. It was a brutal, unforgiving process that wiped out thousands of livelihoods, but it also built the highly efficient, globally interconnected industrial machine that dominates our modern world.